Hello, everyone. Today on the final bar, my guest is Keith Fitz-Gerald, principal of the Fitz-Gerald Group, joining us from the Seattle area here to give a take on the S&P and also a key stock to be aware of. The S&P really selling off into the close here. I've been looking at a lot of rotation downwards. So what does that mean for the long-term picture? Still holding up okay, but looking at defensive groups like utilities starting to rally, testing the 200-day from below. So what's next for stocks? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of the market activity from a technical, behavioral, quantitative perspective. Look at the short-term movements of today, most importantly, connect them to the long-term trends and understand how these trends have evolved. The themes we've been talking about in recent weeks are this general leadership rotation away from mega cap tech, the FANG man, the MAGA trade, these big mega cap tech consumer communication services names that have been the strength for the longest time, and potential rotation away from those groups into other sectors. And today, sort of was a flat day up until about an hour ago, and then you really saw acceleration to the downside of the S&P 500 with Utes and real estate, really the defensive parts of the market, moving up toward the top of the list. So we're going to get to what this means for the long-term trends, and again, the goal is to focus as much as possible on the long-term trends and how they're evolving. We have some great guests coming up this week on StockCharts TV to help us make sense of those things. Today, we have Keith Fitz-Gerald, as I mentioned, from the Fitz-Gerald Group joining us. Tomorrow, we have Louis Yanis from WealthNet. And on Thursday, Larry Berman joining us from the Toronto area from ETF Capital Management. Next week on the Final Bar, we have Andrew Thrasher joining us on Tuesday. We have Gary Dean from SentimentTiming.com joining us on Wednesday the 5th. Also, as a reminder, next week on Monday is Al Brooks. He was actually on our show last week or the week before, if I remember right. And we had an interview with him not too long ago that we'll show on Monday, August 3rd. That's our sister show called Behind the Charts, where we do a deeper sit down with prominent strategists, traders, technical analysts, and learn how they got to where they are in terms of learning the technical toolkit and how they approach the markets. My conversation with Al was really, really interesting. So join us for that as well. Getting to our market recap here, as I mentioned, there's really distribution during the day. And as I've mentioned to my daughter, my 12-year-old daughter, a number of times, if you really want excitement in your professional career, find a way to host a closing bell show in this current environment, because things are fluid, folks. And, I was sort of mentally prepared for a choppy sideways day around 2:30, 3 o'clock. And then I look as we're preparing for the show and watch things fall very quickly. And that's the nature of where we're at right now with quick changes. So I think more than ever, it is important to not make sweeping decisions based on short-term information. And in general, making long-term decisions on short-term data usually isn't a great idea. Making long-term decisions based on long-term trends, that sounds a little more reasonable. So let's see how today played out and what it means for the long-term trends. The S&P down about 0.2%, below 3220 again. The NASDAQ 100 leading the way further down 1.33%. So it's down to 10,532. Mid caps and small caps down more than the large cap index. So this is overall, to summarize, sort of a risk-off day, and that really accelerated going into the close. The Nasdaq really was down for much of the day, but really accelerated there at the end of the day. The VIX back up to around 2550. Bonds overall, the TLT, looking at bond prices, really rallied and didn't look back, finishing more toward the highs of the day, up over 0.2%. That puts the 10-year yield down below 60 basis points. And the dollar really finished flat with the UUP similar to where it was before. Gold continues to impress. The longer-term uptrend continues to evolve. Silver, notably, not participating in the upswing, rallied into the close really, but really finished down from yesterday. So really gold, the positive outlier there within the commodity space. Looking at a daily chart of the S&P, this is what I mean about, not drawing too many long-term conclusions from short-term data. Today in a vacuum, certainly more of a risk-off day. There was movement away from tech, consumer, discretionary into things like utes, real estate, consumer staples. It's kind of what defensive days look like. But, a trend is built up of a series of defensive or offensive days and how that trend evolves. And so in a raging uptrend, you will have distribution days like this. In a raging downtrend, you will have up days where it's more of a risk-on feel. So let's pay attention to the longer-term trend. And so, the positive here, starting there, is the fact that the most recent swing has been a swing to higher highs, and the high last week for the S&P 500 pushed it above the June high, which was pretty significant. So we talked about breaking above that level around 32.30 or so was pretty significant. As long as we remain above that, it's sort of all trends looking positive. What's happened now is we're back below that sort of most recent swing. So we had the swing high in June. We tested that resistance a number of times. We broke above it. Now we're back below it, and today we once again closed below that level. So it's not the all-in raging uptrend it was a week ago, but overall, higher highs and higher lows are an uptrend. We have last high was higher than the previous one. The most recent low so far is higher than the previous low. So as long as we remain above that swing low around 3110, 3120, that's about where the 50-day moving average is as well. I think on any pullback, that's immediately where my eye would be going to and seeing if we're able to hold above that support. And if we do, by definition, the trend remains positive. So don't get too scared out because of a little bit of a down move, a little bit of a corrective pattern. That's normal, even within a long-term uptrend. When we start breaking down through support levels, that's where I would start to get a little more concerned. Having said that, I think one of the overlying issues we have, and this is something that's been with technology for a while now, we're seeing it with the broader S&P, is this bearish divergence of higher highs in price, lower peaks in the RSI. Again, for me, that's not enough to say the trend is over. That's enough to put it on my watch list, enough for me to focus on it. But until we get a breakdown of support, a confirmation of a downtrend, then I think until then, it's just suggesting that something may happen. It's not saying it certainly will happen. We talked about the sector rotation. I think it's also worth noting the XLB materials, which has been one of the stronger sectors on a relative basis, certainly down over 2% today. So this really was a rotation away of what has been working recently into things that really have not. Utilities are actually a really interesting chart. I just want to look at that very quickly, looking at the XLU. So the XLU is testing the 200-day from below. What's interesting is it's done this a couple times, and each time it's sort of failed. It first tested the 200-day in April, tested it again here in June, tested it again in recent weeks. Now we're back up above that. Again, if and when utilities are able to hold that, break above the 200-day and hold it, that would be a significant change. You can see the relative strength just starting to turn up. It's not enough for me to feel like this is, super exciting upside, but it may be. It's all about what happens from here. And if we're able to hold above the 200-day, a break above that swing high from June would be key. So while the S&P has broken higher, you can see how this is certainly has a lower high over the last 4 to 5 weeks. What else can we see on the charts here? So Tesla obviously is the number one stock in our scooter reports. The scooter reports are filled with some of these names like Tesla, like TSM, Taiwan Semiconductor. These are names that have essentially gone vertical and now sort of correcting a bit, sort of chopping around. So it's all about the staying power on some of those high-ranked names right now. Not all of them. So things like Regeneron have been, ABMD, eBay have been up in that list pretty consistently. So it's a mix of things. Interesting to see Newmont Mining back in the top 10 of our scooter reports using the large cap rankings. Newmont had been one of the top 5 stocks for a while then and pulled back as some of these other tech, healthcare, and other names sort of moved to the upside. But back in the top 10, I think reflecting the strength in gold and the gold equity trade. Looking at the industry groups and what sort of happened, interesting to see a bit of a reversion here. So airlines, which have been a weaker group in the top 10 in terms of today's gainers on the industry side. This is the Dow industry groups, about 105, I think, industry groups here. Most of the top 10, 5 of them are REITs, so hotel and lodging, retail REITs. These are all industries coming out of a pretty beaten down level. So again, this is why this feels more like a mean reversion and not like a huge change in trend. I think a consistent pattern of this sort of move would certainly make me feel otherwise. But at this point, it's the have-nots that are coming in, getting a bit of a bid to the upside. No love with energy, though, and you can see a lot of the energy groups, in particular renewable energy equipment, rolling over pretty heavily off of a relatively strong move. Home builders, which we talked about yesterday, it's actually interesting. This group actually gave a bearish engulfing pattern. So that's when you have a big up day, and then you have a big down day where the second day's body, the open to close range, engulfs the first day's body. So it's down 3% today. What that suggests, coming out of an overbought region, a bearish engulfing pattern, it's kind of similar to what you saw in late May. Overall, the long-term trend remained positive, but it saw a bit of a internal weakness, suggesting some short-term strength. It took us quite a while. It took us 6 weeks to eclipse those highs. So, while home builders have been looking good, we mentioned those yesterday, this bearish engulfing pattern suggests a bit more short-term weakness rather than strength. And again, if the long-term trend is positive, that speaks to short-term weakness and potentially more viable levels in the short term. But again, it's all about key support levels and where they come back to. Also, automobiles, that's where Tesla and others are in there, are down a pretty good amount as well. I think that's it for the market recap. We've got a lot of other charts to get to, but the mailbag, I think, hits on some key themes as well. So we're going to take a quick commercial break. We'll be back with my guest, Keith Fitz-Gerald. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday for the show. As a reminder, we love hearing from you and answering your questions anytime we can on the Final Bar mailbag. 2 ways to get a hold of us. Email us at thefinalbar@StockCharts.com, or on Twitter, just tag us in a comment at FinalBarSCTV. We'd love to hear from you. We received so many great questions and feedback on the show. We appreciate it very much. We'd love to answer one of your questions in one of our future mailbag segments. I want to welcome on my guest, Keith Fitz-Gerald. Keith's a principal at Fitz-Gerald Group, local here in the Seattle area, although I know you're split time, Keith, between here and across the ocean over in Japan. But really, it was such a pleasure to meet you at a money show not too long ago. We had grand plans to have you in our studio, which at some point, fingers crossed, we will get to. But for now, we'll accept a virtual visit. So, Keith, welcome to the show.
Thanks for having me. It'd be terrific to get down there. And I, for one, cannot wait to have some semblance of normal behavior. But truth be told, I'm forgetting what normal looks like now.
But not today, unfortunately for us. But you sent a couple charts ahead of time, which I appreciate. The first one, we're starting with the S&P 500. We just talked earlier in the show with a recap, thinking about the big picture. Tell us what you're seeing on a chart of the S&P here.
Sure. One of the things that I like to do is, I'm a self-described techno-fundamentalist. I want to mix and match the two things. I'm looking for what I call confluence, where, other traders would say, well, I'm looking at convergence of various time scales, or I'm looking at price points, et cetera. I use nonlinear analysis, and what I'm seeing here is that the S&P 500, the SPX, specifically what this chart is, we've got tremendous confluence in that 32-39 area. You see the pink lines coming at you from the left, and you see price activity just concentrating there. You've got a 5 and a 10 moving average. These are funky versions of moving averages that I use, but nonetheless, you got a lot of activity there, and it's like a slinky. It's coiling up energy. The market's getting ready to bust a move. We don't know where it is going to go, but what this tells me, and I've learned to pay attention in nearly 40 years I've been doing this, is when I see confluence of several key analytical methods that I use gravitate towards a single price point, the hair on the back of my neck stands up. I get ready for both up and down movement, because chances are it's going to be a good one.
It's really, I love that the simplicity of what you just said, which is you focus on a key, a key price. So I think a lot of people, there's a question mark in terms of what would come next. You have highlighted on the chart the 31.3853 level. Can you talk about is that a downside risk, or is that a point where you would revisit a bullish thesis? Tell us what that is telling you.
That's actually that's a good logical thought, but I use those points differently. They are calculated. If you were to use a conventional indicator, you could use an adaptive trailing return, or a stop and reverse point would be the closest thing you could get to the suite that I use. But 31.38, if we breach that to the downside, that's actually the point at which traders are going to take the downside breaks off. They're going to go risk off and we have an elevator ride lower. So if we do below the 3,200 from a stop and resist standpoint, that's probably the area that we have to hold if we break down the next day or two.
It's a good take, Keith. Now, chart number 2. Obviously, we've talked a lot about leadership rotation and some of the larger names, correcting a little bit, sort of pulling back, but overall have been absolutely resilient. And Apple is probably a perfect example of that. Where are you at looking at the chart of Apple here?
Same kind of thinking applies. This is slightly different. The blue line is the 200-day moving average. The yellow is my version of a volume-weighted average price. And what this tells you is off of the March low, Apple has really just lit it up. And we all know that anecdotally because it's very, very expensive. Now, many people would look at this chart and say, aha, it's got to go lower because it's so high. I don't think so. What this is telling me is that the rest of the market's simply going to catch up. One of the things that people who are looking to analyze Apple fail to grasp many times is that Apple is among the most liquid securities in the world, which means every bank, every institution, every pension fund, every major player owns, hedges, or trades Apple. So as the economy worsens, as we start to look towards the post-COVID environment, this is one of the very few stocks that is going to attract money regardless of how market conditions function.
It's true. And when you think about an institutional money manager benchmark to the S&P, there's a career risk at some point with not owning a name like Apple,
Exactly.
right? I mean, just with the size and the weight and the benchmark. So when you're looking at this chart of the S&P, when you're looking at the chart of Apple, where, outside of those, where do you see opportunity? If you had new money right now, is there a particular area of the market, a particular theme or spot where you would start to consider, or what are your thoughts?
Absolutely. As a matter of fact, I'm still putting new money to work now. I'm doing it very carefully, but I'll tell you what I'm doing personally. I call this the bookend approach. You've got to have there's no middle ground. On one end, you've got technology, you've got things that are improving, that are getting stronger because of COVID. That's going to be stocks like Microsoft and Apple, both of which I own. That's also going to be stocks like Pfizer, for example. And then you go to the other end of the bookshelf. You're going to see JP Morgan. You're going to see Visa. You're going to see Gilead. You're going to see companies that are maybe not necessarily there yet or haven't had a lot of interest, but there is no middle ground. At the opposite ends of the bookshelf is where you're going to find the stuff that everybody wants to gravitate to. And in between, not a lot of middle ground, not a lot of solid earnings. Simply risk I don't want to take. Defense is another area where I'm keen. Raytheon Technologies, as you know, had very good numbers today, and that's another stock I'm looking to accumulate.
It's a fantastic take. Keith, it's so good to hear from you again. I'm so hopeful we'll have you in our studio in Redmond, not too far off, but until then, really appreciate you joining us virtually. Look forward to having you on the show again soon, all right?
I would love it. Thanks for having me.
It was Keith Fitz-Gerald. He's a principal of the Fitz-Gerald Group. And again, it was such a pleasure to sit down with Keith at a money show not too long. It feels like a lifetime ago, though, because so much has happened since then. But I've really enjoyed getting to know Keith and his work. I think he has just a beautiful, simplistic, but powerful take on how to think about positioning, how to think about where to lean in and lean away. So good to have him on the show for sure. We need to move on to our next segment, which is the Final Bar Mailbag. As I've mentioned many times, we so appreciate hearing from you guys, and especially things you're running into, questions that come out of the normal process of analyzing charts. And hopefully, again, what StockCharts.com is designed to do is empower you to make better decisions with your own investments, with your portfolio, with your clients' portfolios. But questions are going to come up along the way, and hopefully we can provide one way to help you navigate these markets and navigate technical analysis, behavioral analysis. We want to start with a poll. We asked you not too long ago, what do you think happens first? Tesla's top of mind as I was making this poll. What do you think happens first? Choice A, Tesla breaks above 2,000. Choice B, Tesla breaks below 1,000. Or choice C, election day, November 3rd. So basically, to summarize, does Tesla break above 2,000, which would be, again, not too far off when you look at the chart? That'd be up about here on the chart. Or does it break below 1,000, which would be below the 50-day moving average, back down to where it was in late June? Or did neither of those things happen before November? The votes are in. The most popular response, although not a majority, was election day, November 3rd. 44% of you thought neither of those would happen before the beginning of November. A third of you, 36%, said we'd break above 2,000. 20% said we'd break below 1,000. So what would my response? I actually did not respond to this one. I don't think breaking below 1,000 is likely. It's certainly possible, but I don't see that happening. I actually agree with the popular answer. I would say election day, November 3rd, only because what we've seen now on the chart of Tesla for the first time in a long time is a supply factor, or a level of resistance that we've been unable to eclipse. I've seen distribution candles. I'm seeing dark cloud covers. I'm seeing bearish engulfing patterns. And again, not that my whole world is run on candlestick analysis, but the stock was overbought. And then we've seen all these short-term candles showing you that buyers are exhausted, or there's an influx of profit taking. There is something that is causing the price to come down a little bit. And until that changes, I think 2,000 may not be in the cards. We break above the high from July. You'll hear me proclaim that very quickly, though. Let's get to the rest of the mailbag. Thanks so much for answering those questions. More polls all the time on our StockCharts TV page. Question number one. Sorry, I'm going. Been in gold stocks until right. I want to add a column in a scan report. I knew there was a reason why I put this on the list here. Basically, I was looking at different groups, and I'd like to ask you, how do you add a column in the scan report? And I think what you're doing is you're running a scan down here. This is on my list. This is just a simple scan saying members of the S&P 100, so I know what the results are going to be. How do I change these columns? The short answer is you have a limited ability to change those columns right now, and there's a little button to the upper left when you run a scan that says columns, and you can change what's on here. Same thing when you look at a chart list, you can change some of the columns on there. It's relatively limited. The good news for all of you, though, is part of the ACP platform that we've been designing and just been rolling out to all of you. We're actually adding a little panel below the charts. I can't show it to you just yet, unfortunately, but it's coming very, very soon. There's going to be a panel down here that you will be able to customize to a great deal. You'll be able to bring in price data, technical data, fundamental columns, all sorts of different information that you can do, and you'll actually be able to scroll through the results and look at the charts one by one. It's actually a really cool feature of ACP that we're developing at the moment, coming soon for you. So the short answer is you're very limited. You cannot add the column like RSI in this current platform within the scan engine. Someday maybe, but it's not happening today. Within ACP, you'll actually have the ability to create a custom report very, very soon, and that's where I would be looking. We'll let you know for sure. We'll make a lot of noise when that's ready. Question number two, can you tell me the easiest way to get a list of the stocks in the S&P 500? There are a couple of different ways to do this, to be honest with you. I have a scan, which is very simple, and I'll show you what it has. And sorry for jumping around. On your dashboard, if you go down to your scans, I actually just have a scan called S&P members. If you know our scanning engine, it's the most simplistic scan you can ever do. You just add a line called group is S&P 500. If you're not familiar with how to do that, in the scan engine, there's a drop down under indexes and ETFs. You can actually use the members of a number of different common indexes and just say add, and it'll add a simple command that does that. You can run the scan and you can get the group. Another way that a lot of people use, though, is on the dashboard. If you create a new chart list, so if I go to chart lists and then say new and say Dave's kids are great, they'll get a kick out of that. We say create new list. I don't force them to watch the show, but I don't mind if they do. At the bottom here where it says add charts to list, this is the way you'd manually add charts onto your watch list. You can also say from group, and here you can say SPX members. So that's probably the way I would end up doing it, because then you have them in a chart list and you can start looking at different things as well. So those are the two ways that I would get a list of stocks into StockCharts and then go from there. The chart list one that I just showed you is probably the best idea. Next question, actually the next two questions are very similar, so I'm going to answer both of them. Could you suggest how to watch or track advances minus decliners for the NASDAQ and the S&P 500? Have you found it to be a value? And the answer is yes, and I'll show you in a minute. Second one is the cumulative difference between stocks closing higher and stocks closing lower, the NASDAQ and the S&P, and a moving average. So all of that is sort of the same thing. So there's different ways we can bring that in. Part of my Mindful Investor Live chart list has a chart like this. So you are welcome to take the charts that I've created and then customize them if you want. This one right here is breadth by cap tiers. This has the cumulative advanced decline line for the S&P, for the New York Stock Exchange, the mid-cap index, the small-cap index. Most of the time, you look at it in a cumulative measure. So you accumulate the values over time, and you do that so that you can understand how those values have evolved. These exclamation point, AD line, SPX, these are the tickers on here. These are cumulative indexes that are preloaded. You can also, if I go to the breadth list that I have, let's see, new highs, new lows, advancer, decliner. So we actually have just advancer, decliner numbers that you can actually do. So this chart that I use is part of the breadth chart list that I use very often. This actually just does a ratio of $NYADV, which is advancers on the New York Stock Exchange, relative to the total number on the New York Stock Exchange. So I basically want to say what percent of stocks are advancing versus the total number. So using the chart, the Sharp Charts tool, using these different tickers, you can manipulate them and add moving averages. You can chart them as cumulative numbers. So instead of a histogram, I could say cumulative. So I could start the clock at a certain point and just add those numbers back and forth. You can overlay. I've overlaid a horizontal line, but you could overlay a moving average, which is what you asked about. So here's what I would suggest to you, since I've given you about 12 different options. You are welcome to start with either of these charts that I just showed you. The best way to do that is if you go to, let's see, if you go to your dashboard and you go to chart lists. I have a ton of these, so sorry for that. But if you go to the bottom, you will have an option to look at chart packs. And if you click on that, you'll see my series called David Keller's Morning Coffee Routine Chart Pack. If you already have this installed, both those charts that I showed you are actually already included in the breadth chart pack that are installed. That if not, just install this, and it'll put a bunch of chart lists on your account that have all of these. You're welcome to tweak the ones that are included there, or you can just use the tickers that are on there to create your own. And it's all about just using the panels at the bottom, using cumulative or histogram, adding moving averages, whatever that you'd want to do. But that's the way that I would follow those indicators as well as you can. Those are all questions that came from you in the last day or two. Thank you guys so much for sending in some really thoughtful questions. I didn't get to all of them. I'll get to more later in the week. We need to wrap up the show, though, and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the, it's funny, we just mentioned this, the S&P breadth by cap tiers. And the reason why I wanted to show you this is, again, on a down day, right, today was sort of weaker. You saw the distribution going into the close. And again, what I would caution you of doing is drawing long-term conclusions from today. Today was certainly more distribution than accumulation. A pattern of that over time certainly speaks to weakness rather than strength. I think there certainly is corrective movement that needs to happen, and I think the bearish divergences we've seen speak to the danger, the risk of the downside. But when I'm looking at the cumulative advanced decline lines, I'm seeing the S&P making new highs. I'm seeing the New York Stock Exchange, the mid-cap index, and the small-cap index all sort of sideways. So until you see these start to break down, there's not a meaningful sell-off happening yet. This was still a down move within the context of a longer-term uptrend. For me, it's all about looking at those key levels. I think my guest, Keith Fitz-Gerald, talked about 3,200, and if we're able to hold that, I think that's totally fair. I think looking at breaking down previous swing lows would be an important first step, not just on the S&P, but on individual stock charts as well. Chart number two is looking at consumer discretionary versus staples. I wanted to highlight this because this has evolved actually in a pretty interesting way. The cap weighted ratio has now broken down to a new 2-month swing low. It's almost doing it, maybe a new 1-month low. It's done. It's testing these lows from sort of mid-June, but a rotation lower basically speaks to strength in consumer staples versus consumer discretionary. That's actually a new pattern than what we've seen in the last 3 months or so, coming off of the March lows. The equal weighted version broke down quite a while ago, right? So in mid-June, you saw more weakness in the equal weighted consumer discretionary versus the equal weighted consumer staples. And all this does is it takes the overweight in Amazon, but the weakness in this ratio is telling you even the mega cap names are not able to hold up consumer discretionary. Overall, it's all rotating more toward the side of consumer staples. Again, still early on in that theme, but it's an important chart to watch. Finally, we have the utilities index, the XLU. We talked about this a little earlier in the show, so if you missed it, go back and listen to the details there. But it's testing the 200-day moving average from below. I'd want to see if it's able to hold it now that it's closed above it, and the relative strength just starting to improve. So outperformance from utilities would be sort of a different look than what we've seen in a little while. That's our show for today. I want to thank my guest, Keith Fitz-Gerald from the Fitz-Gerald Group, for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.